So the income that you collect from the first 2 tenants will cover your core costs of your mortgage. Then the third one, and sometimes spills over to the fourth one, will cover your outgoings, your bills, because in a HMO often you're covering all the operational costs. Your profit is in the 4th room. Now if you've got a 4-person HMO, what will happen if one tenant moves out? For me, the profit is in the 5th and 6th room, and if possible 7th, because your base costs at this point are all covered.
So for the rest of the afternoon, something a little bit different, where we're going to move our focus from business to property. And you will see lots of synergies between investing in property and investing in businesses. And a lot of the skills are also transferable as well. So please would you give a welcome to former masterminder and very professional property investor, Saj Hussain. Thank you very much, Saj.
Thank you. Please, don't stop. I've been involved in property about 18 years now. I've always been in business. Left university early 90s, started an IT company, putting the first PCs on people's desks. Made very good money from that for a number of years, probably about 14 years around that business. And then I think I outgrew my smartness and I thought I was invincible. Did some very stupid things, and in the end the whole thing imploded and collapsed and pretty much wiped me out, so I lost everything. So about 18 years ago I started the second career, which is property. And what got me into property was thinking about what can I do that will maybe outlive me, that will be asset based, rather than something that I'm having to exchange time for money for and working the way I was. Now I'm still working just as hard as I did then, but I probably enjoy what I'm doing much more now than I did then. And it got me interested in thinking about property. Anyone read the Sunday Times Rich List? Yeah, 1 or 2 people. Yeah, so I'm a big fan of that, and they started, I think, late 80s, if I remember correctly. And I'd look through that and be inspired by how huge amounts of wealth is created. And much of it is either kept in property or created from property. And that's where the fascination really started for me. And the idea often is the case you need a lot of money to get started in property. And just like you learn in business, actually that's not necessarily the case. You can acquire businesses without having a huge pot of cash. Property is not that different, as Jonathan alluded to earlier on. There is a lot of overlap in terms of how you can acquire and put deals together. So that's a little bit about my background. When I started with no money, the skill I developed very quickly, and this was probably about 2007, around that time, was sitting down with sellers and say, hey Ben, you're looking to sell your house. I see like no one's buying right now. How can we help get this done so you can move on? And just developing that skill of buying directly from vendors. And I say buying, I wasn't buying myself. I was agreeing a deal and then finding somebody else that would pay me to take on that deal because there's some profit locked into it, and essentially developed from there. And then after a couple of years I started partnering with other people to say, hey look, rather than me selling this opportunity to you, say $5,000, and you're going to make 40 or 50 grand on it, what if we partner on it and I'll do the work and we can have a profit share? And then it transitioned into some buy-to-lets and flipping, etc. And that was the journey. And over time we've done lots and lots of different things in property. And in property there's many different ways to make money. Just as you can in business, there's many different strategies. And I said I'm not here to persuade or influence you on any one particular, but it's really a case of showing you where the possibilities are. My belief is there's really only 3 ways to make money from property. This is my belief. One is that you're generating regular reoccurring income each month. And so what that means is each month that you get some kind of income coming in for the effort you put in once. You acquired the property, you've renovated, you've put a tenant in, and you're collecting income. So for me, cash flow is not a couple of £100 a month. We're generating £800, £1,000, £2,000 a month from a single property. For me, that's what cash flow is. So cash flow should be something that could replace a salary. Not necessarily from one property, but maybe from a handful of properties. But many people do buy-to-lets that generate £100, £200 profit a month. But you need an awful lot of those before you start replacing a salary. You start building huge portfolios to do that. So for me, cash flow is either HMOs or serviced accommodation. HMOs, multiple occupants, i.e. a little bit like a student house where you've got 5, 6 people living together. Rather than one rent, you've got 5 or 6 rents coming from a single property. And service accommodation is really a mini version of a hotel, where effectively you're selling accommodation for a much shorter time frame, like your Airbnb model, by the night or by a week at a time, rather than a standard 6-month contract. So cash flow in terms of high income is what the core focus is for many people. Then we've got cashing out of deals. Cashing out of deals is when you are doing all the work but only getting paid once. So by that I mean, for example, renovating property and then you sell it and you make a profit, but then you go again. So you are exchanging your time for money regularly, rather than the first one, which is generally investing. And so when you're investing in property, you've got to think about, is it something that's just an investment that's going to produce a return? Or are you going to be actively involved in running a business like some of your other businesses, right? And so cashing out generally is flipping, is what you're doing. You're buying, renovating and selling. It may even be developing, where you take a building and reconfigure that, change its use maybe. For example, a common thing right now is turning office buildings into, say, apartments. It might be you have a plot of land, you build something on that. So that's you're developing, but again, you're putting all the effort in, but you're getting paid once from that. And your third one is equity. Equity you're building over time in an investment. Now, equity is profit, kind of, but it's locked in the property. It's not the kind of money you can turn up to Tesco's and say, stick it on my equity card. It's not money you can tap into, essentially. But over time, you'll get a return. So why is it some people still invest in this way? Well, our belief is, most people, is that property will continue to rise over time. Prices just continue to increase. Some people say they double every 10 years or not. Regardless of what your opinion is in terms of how frequently that might happen, we generally have the belief prices just continue to increase, And so there's a shortage of accommodation in this country, right? But the reality is, when you look at a map of the country, the vast majority of England is not built on. So when you think about it, you think there's no shortage of land. There's no problem with space. So what's preventing all these homes being created? There's the regulation, it's control, and who runs the planning department? Okay, the government. So you try and figure out, what are they thinking? Because ultimately they control what happens in the market. The government has some huge levers in the property market in terms of which way they want it to go. So the government has a big influence in terms of what happens in the market. And whether we like politics or not, we want to be aware of what the general sentiment is of the government and where they want to take it. And how do you think landlords and developers are seen by the government?
Haters. Vultures.
Absolutely haters. Yeah, you got it in one. We are not popular, and because we don't get them a lot of votes. But tenants do. Tenants are a huge sector of the voting community, so appeasing your tenants is much more important for them than trying to please some landlords. And hence, many more rights starting to appear for tenants, as opposed to balance it out with landlords. Personally, I think it's already been very unfair for a long time, but it will get even more unfair. It's difficult to know exactly what they're thinking, because a lot of stuff doesn't make sense. It's difficult to say, why on earth would they do that? So, for example, Section 24, is any familiar with Section 24? Have you heard the term? So Section 24 is, what's happened is, say, Akash, say, you purchase a property, you take on a mortgage, and you've got, say, £500 a month rent coming in, and your mortgage is £400. How much gross profit is he made? £100, right? So at the end of the year, all things being equal, you've got a few other costs, you're going to be paying tax on that £100 a month profit is made, roughly. Does that make sense? Yeah, we all understand that, right? But the government says, well, hang on a minute, you know, this interest thing that you are deducting as a cost, let's scrap that idea. Why don't you just pay us tax on the 500 quid instead? That's essentially what they've done, which is called Section 24. It happened a few years ago, and there was no escaping it. So everybody that owned property in their personal name, other than their home, now gets taxed in this way. It was staged over 4 years, so it gradually became very painful. There was this talk about landlords are going to exit the market in droves. It didn't quite happen, but there were some people that probably did move on. But of course, investors, landlords, they started looking for other ways to do things. And the solution that came from that is, going forward, people started buying property in companies. Because in a company, you can still offset the interest as a cost, whereas you can't do in your personal name. So most property purchases, investments that happen now happen in a company rather than in your personal name. And your taxation is different as well. But then, of course, there's the idea of, now they've got them all over here, now they know who owns what, there might be another agenda. So the biggest landlords in the country have been individuals. There's many that own literally thousands of properties. But who has expressed an interest of becoming large landlords? Banks, insurance companies, pension companies. Was it one of the supermarkets? I can't remember which one. Is it Waitrose? Because they own all these enormous buildings. Why don't we turn some of them into apartments? Why don't we start investing the money in property? So they have been looking to do that, but they've actually kind of taken a little step back because it's not quite what they thought it was going to be. Very different to how it is in America. There's a lot of residential property owned by big corporations in America, but that's not the case here. We're very different here. And even when it comes to property, we have this fascination about owning property. It's a very sexy thing to do. We just go across the ocean to France and Europe and anywhere else. Nobody has this fascination. So we're very unique in terms of what happens in this country. So when we're thinking about making money from property, what we should be doing is, before we start, begin with the end in mind and think about which one of these is the one that's important for you. So it's thinking about, are you trying to get into property to create cash flow, so it's another income source, or are you looking to create a business because you have to invest some time in that as well if you want to build it as a business? Maybe you're developing, you're flipping, or are you essentially parking cash for a return? So now when it comes to the journey that many people follow when they get involved in property, it tends to be this aspirational route that they tend to follow. Many will start off with buy-to-let investing, where they'll buy a property and they'll rent that out. Sometimes it's accidental, meaning it could be a couple of people that have come together, they now moved into one house, they've got this other one, they don't particularly want to sell it. Why don't we just rent it out? And you become accidental landlords. You buy a house where the kids are at university, for example, which is 100 miles away. They graduate, they move on, and now you've got this buy-to-let in the middle of nowhere. And so you're accidental landlords. So sometimes people build a portfolio in that way. And then because the prices have continuously increased over time, apart from little bumps along the way, but generally it's an upward trend, people have then borrowed more money against that asset to buy the property. And that's how buy-to-let investing worked for a very, very long time. That's how people have built these enormous portfolios, because the values keep going up, they keep borrowing more money and they buy more property. And then what happens is some people think, well, actually, you know, I've watched a couple of TV programs, this Homes Under the Hammer stuff, it ain't that difficult. I can get a lick of paint on a wall. And so you start doing a little bit of refurbishing. So rather than buying the property and just renting it straight out, you might want to do a little bit of work to the property. Or maybe you'll renovate it and sell it and then buy another one. So you're either flipping or you're improving the property. So the BRRR strategy is you buy the property, you refurbish it, you refinance it, you rent it out, and you kind of repeat the process and you continue to grow the portfolio in that way. So effectively, you're building it on debt. But because there's constant increase in values, that's what makes sense. What would happen, it would be very easy to borrow most of the money you needed to buy property, and property prices continue to grow, will go up very quickly. So money was easy to get, prices continued to grow up, and then it fueled this massive growth. But as they realized a lot of this money that they were lending, actually they were lending to people that are probably never going to be able to pay this money back. It was just irresponsible what they're doing. The whole thing imploded, and the banks did their classic thing and take a massive step back and said, we're not doing this anymore. And then went to the other extreme of being much, much more stricter in their lending criteria, which is generally where we've been probably over the last 20-ish years now in that space. So when you're refurbishing a property, you're improving its value. You're adding value to that property. And if the value's increased, then you can go back and borrow more money against it. And the idea or the theory is you've extracted all your money. So if your purchase of property is £100,000, and let's say you put all of your money in and you generate £10,000 a year rent on that, what's your return on capital on that? Yeah, 10%. I just wanted to check no one's fallen asleep. It's 10%, right? No trick question. It's about 10%. Now, let's say you borrowed from the bank. Let's say you bought it for £100,000, put your cash in, and you're generating £10,000 a year, and then you borrowed £100,000 from the bank against that property. So you've got all your money back. Now you've got a mortgage to pay. Let's say the mortgage is £7,000. So you've got £3,000 left a year. So what's that £3,000 as a return on your capital now? It's infinite, because your money is already out, right? So this is the concept of this BRRR strategy. The thinking behind it is that you continuously borrow and extract your cash to build a portfolio. It comes back to that previous strategy we talked about. It's an equity strategy, meaning it will make you probably very wealthy over time but it's not going to make you a lot of money now. It's not a kind of strategy that'll probably get you out of a day job. Once people have got a little bit more comfortable with a little bit of light renovation on a property, the next step generally tends to be bigger renovations or high income, which is your HMOs or serviced accommodation. So when I say HMOs, what comes to mind? The first thing that comes to my mind is ka-ching, ka-ching, right? And just like any business, there'll be certain businesses that function that might be hassle, that might be headache, that might be hard work, but they produce huge amounts of profit. Now you can choose not to get involved in them, or you could look to see who else operates businesses like that, but they do a fantastic job of running those businesses. They've got the systems, the processes, and they have the scale in terms of how they build those and replicate those ideas. And that's how I think you should be building your property businesses if you are hands-on, because they are businesses and people don't treat them as businesses, people treat them as investments. I stick a bit of cash in it, now I've got tenant doesn't pay, I've got a headache. Well, did you do the proper checks? I don't know, Bob next door said to me he knows somebody that can pay you cash each month. So your HMOs are definitely going to be more work, and often it's a case of we don't know what we don't know. So our portfolio is probably about 500 units, mostly HMOs and serviced accommodation, and the rents that we'll charge be right at the top end. But just like with all businesses, you can choose where you operate. So when you think about HMO or serviced accommodation, you decide what sector you want to operate in. So all of our tenants in our HMOs are mostly graduates. They've left university, they like the idea of living with other people, the early 20s to mid 30s age range, generally good earners, and our properties in locations where we can command much higher rents than most of the market. So not only do we make good profit, we probably make more profit than most people that operate HMOs. So you can choose the type of accommodation you want to create, who you want to create it for. But before you do that, you need to understand there's a demand for that. So this is where, before you commit to what you're going to do with the property, you need to understand the location. You can't change the location. You can do anything else you want with the property, but you can't change the location. So you have to think about who wants to live there before.
Are you a business owner and you want to grow via acquisition? Then you need to be part of my Mastermind program, where we hold your hand all the way through the entire process to make sure that your first acquisition is a resounding success. I put some information in the video description below.
I'll kind of briefly explain how I would look at a HMO in terms of how it works. And the model, this is particularly our model as opposed to all models, because there's lots and lots of different versions of models. But when we think about HMOs, you've got your professional lets, you've got students, you've got like social housing, asylum seeker contracts. There's lots and lots of variations of shared accommodation. So when you've got a house, let's say it's got 6 units in it, 1, 2, 3, 4, 5, 6. Clearly don't draw or count very well either. Now what you've got is, generally speaking, the income from the first 2 will either pay the rent or the mortgage, rent if it's leased, or a mortgage. So the income that you collect from the first 2 tenants will cover your core costs of your mortgage. Then the third one, and sometimes spills over to the fourth one, will cover your outgoings, your bills, because in a HMO often you're covering all the operational costs. What sort of operational costs are we thinking about?
Cleaning, electricity, Wi-Fi.
Yeah, Wi-Fi is the most important. Let's get it the right way around. Gas, electric, water, council tax, TV license, cleaners, gardeners, internet, all these things you're responsible for. So all of those are costs. So generally 3 to possibly spilling over to the fourth one is going to be covering your costs. So when you look at it like this, your profit is in the 4th room. Now if you've got a 4-person HMO, what will happen if one tenant moves out?
Break even.
Yeah, you'll possibly break even or maybe even lose money. And what happens to people that live in this way is they're very transient. So they'll come and go, and you've constantly got people coming and going. And if it's a student house, for example, they're going to come in blocks and leave in blocks, but you're still going to have that constant change. For me, the profit is in the 5th and 6th room, and if possible 7th, because your base costs at this point are all covered. And that's why the larger ones make sense. Now, there's also then a tipping point where if you go too big, they will put certain people off. So for example, if you were staying in shared accommodation, you probably wouldn't want to share the kitchen with 15 other people. So although from an Excel spreadsheet point of view, you think, keep sticking more rooms in, please add in more rooms, it doesn't really work so well from a practical and delivery point of view. And if you did have large ones, large houses like that, What we prefer to do is split them into two. So they're effectively 2 blocks of 7, for example, rather than 1 block of 14. If you're charging a premium rent, you've got to create a premium product as well. So it needs to feel nice and attractive for people that are living there. So this is how we can take a house that we'd typically buy for, say, about £250,000. We'd spend, say, 200,000 on it, so we're up to 450, and we can get a valuation of, say, 600 or 650,000. And the reason we can get that valuation is because the income is so high on that property. And that's how we effectively do the BRRR on steroids. Essentially, that's how we do that, and that allows you to continue to grow the property. So you've got good quality properties that are producing really good income. So once you've got comfortable with doing some work and building the business in terms of producing assets that are generating you a lot more cash, often the next step is we want to do this on a bigger scale. That big lump of building over there, let's turn that into 27 flats. So the aspiration generally is you want to step up into converting buildings, larger buildings, into, say, apartments, what they call commercial to residential. And then beyond that, it tends to be new building new houses out the ground, a new accommodation, new block of apartment out the ground. Now, it doesn't mean that everybody follows this route, but often when you're involved in the property community, and I've been running property networking events for about 15 years now, and we have lots of people that we meet and we speak to as well, and you see this as a common aspirational journey. But you ask, why is it you want to do this? Well, people feel, well, I need to cut my teeth with the basics and then jump into where the big money is. They forget the big risk as well. I need to jump in where the big money is. And that's why people tend to think about it in that way. But it doesn't need to be. You need to go back to what we started with before about which might be the right route for you depending on what it is you're trying to achieve, where you're trying to get to. So within the property community, if this was a room full of property people, what do you think they'd mostly say is the biggest challenge? It's not money.
Finding a property.
It's not finding the property. It's not finding the tenants. It's finding good, competent, reliable builders. The biggest thorn in property investors' side is tradespeople and builders. Are all builders terrible?
Yeah.
No. But the point is we tend to tarnish everybody's same brush. We just assume they're all going to be terrible. That's not the case. But this is the biggest challenge or frustration that we have in the property community. Either finding good tradespeople, good builders, or hanging on to them, or as you said, ensuring they stay good. Because sometimes what happens, I've had this a few times with a few people that come along to, say, for example, our networking events, and they're a builder doing something, they're doing a project for somebody, and they've got a good rep. Other people like the work that they've done, and before you know it, they've taken on 7 projects and they're doing a really bad job because they've just committed to too much. Now, there are some people in this room that are already involved in servicing the property sector or the construction sector. So what that means is you have a massive advantage. You have access to people and skills that most of your competitors will struggle with. So it's how can you tap into that? Now, if I'm renovating a 3-bedroom house that I'm going to maybe sell for a profit, and normally when we're flipping houses, we set a target at 100 grand profit that we want out of a house. It doesn't mean it has to be, or we don't get out of bed for less than 100 grand. It's just to make the whole thing make sense for the amount of effort, energy you're going to put into it, the money that's got to go into it. It's got to produce a decent profit to make it worthwhile. So you don't do entry-level property, you start doing mid-range to slightly higher range accommodation to get that sort of a return. Now, I'll have my builder that'll do the work. There'll be probably an architect involved as well, and there are few people that'll be involved. But you end up project managing yourself to make sure you get what you want. But when you go up to, let's say, it's 27 apartments you're about to build, what happens is the game changes completely. You have a number of experts that will be working with you, like quantity surveyors, project managers, and because the profit margin is much higher, you can afford to employ these people to work with you. So you bolster your team of experts that are supporting you on the project. So what that and effectively it can do is de-risk the project for you because there's more smart people working on it with you as long as you hire the right people. It's really important to think about what your strengths are and how you can apply those if you want to build this as a business. Right? So there'll be things that you do really well. Raise your hand if there's something you do really well. Just in case you didn't hear, I know it's getting late in the day now. Raise your hand if there's something you do really well. And then raise your hand if there's something that you just hate doing in your business. But we've all got those, right? So why do we spend our time trying to get better at the stuff we're not good at and trying to pick up the accounts and sort the admin stuff out that somebody's done a bad job at. Whereas why don't we spend our time being outstanding at the thing that we're good at? And just let somebody else take care of the other stuff. Because that's what we should do if we're good at something, and especially if we enjoy it, we should try and spend all our time in that space or being in that flow. Does it make sense? But we don't. In reality, we don't. We spread ourselves thin, we do everything. In the same way here, if you focus on the core skills or what you're good at and what you bring to the table, and there will be transferable skills if you are thinking about property as a business that you'll be able to bring, and then think, who else do I need to plug in to fill the rest of the gaps? Now, when it comes to profit, and you make your money from property in 3 ways. The first is when you buy. So you've probably heard the term, you make your money on the way in, you make your money when you buy. What does that mean?
You buy it cheap.
You buy at a good price, below market value, something. So for example, if a property is worth £100,000 and you bought it for £80,000, well, regardless of what you do next, you've made 20 grand straight away. You've locked in that profit. Does that make sense? So buying well in the first place is your one form of profit. So the acquisition is key, not that different from business as well. And then it's what value you might add. So let's say we're going to flip a property, the renovation we do, the big extension at the back, putting all the glass at the back, the big open plan, all this value add we do is what we're paying for, or what we are getting rewarded for. So that's not the chunk of profit. And then the third layer of profit can be, and one many people don't think about, is the gain that you can make by changing the use of a property. So they're really your 3 ways you can create a layer of profit in your deal. You buy well, is the value you add, or you change its use. So earlier your question was around a commercial valuation, and that's by doing the third one, where we're changing the planning category for a property, and now it's seen differently and the value of that property increases. The smart thing to do is you do all 3. So why is it that now might be the right time? Or is now the right time?
It's always the right
When was the best time to start in property?
2008.
It's 2008. 2008 was a good time. What was the challenge in 2008? You couldn't get the money. There were lots of great deals, but there was no money around. What was the challenge in 2006? There was lots of money, but very few deals. Just swings around about. The market changes, you just adapt with the market. So how many changes have we had in the property market, say over the last 18 odd years I've been involved in? Just like every year there's like 3-4 different things happening, and some people would just panic and say, oh my God, this is too much. I've had enough, I'm out. But you just got to take in your stride. The market adapts, you change. So it's understanding the bigger picture rather than looking at things in isolation. How will it impact everything we're doing? So when we look at the market and we look at, say, graphs like this, and we said earlier, people talk about maybe the property market doubles every 10 years, whether it's 10 or whatever it is, and there's lots of different data you can look at, this represents in the 4 components of how the market works. You go through a period where the market crashes out, then we go through a recovery phase, and then it kind of overstretches and there's a little bit of a correction, prices slow down a little bit, and then there's another boom. And then it cycles back round to another crash again. And this is happens constantly. You see it happening all the time in the property market. So what's the best thing to do? Do we sit on our hands? No, we just find the opportunities within the market. You just adapt with the market changes, you adapt, you look at whatever's to your advantage, you work towards that. Whatever isn't, you just navigate around it. It's really your perspective ultimately, right? It's what you choose to see. Yeah, and earlier Johnson was saying, you know, if you focus on the negatives, that's what you're going to see. And if you are thinking there's going to be positive outcomes, you're more likely to get them. And if you are looking for certain things, you'll see them, right? But if you're not actively looking, you probably drive past or walk past lots of fantastic property opportunities just within a few minutes of where you live and work. But you don't notice them. Why do you not notice them? Because you're not looking for them, right? It's as simple as that. But if you were looking for them, if you said, I'm looking for a tired looking property that might have an opportunity to renovate and improve, you start spotting them all over the place. It doesn't mean that you can turn them all into deals, but you'll start seeing them.
You're watching this because you're interested in buying a business, so get my business buying toolkit free of charge. 17 downloads, videos, reports, and my books as well, completely free of charge. The link is right below.
We're in a room of business people. You understand that your businesses, that you want to acquire and you run don't just run themselves, they require effort. And if you apply the same thinking and the philosophy to property as a business, you can do exceptionally well. So I said it's hard work, but the rewards are phenomenal. Absolutely phenomenal in terms of what's possible in property. So I'll just show you, for example, this is essentially how our HMOs will look when we finish. We'll typically spend about 200 grand renovating a house to turn it into a 6 or 7 person HMO. So they're nice, luxurious ones. And the typical rents for a really nice room in Birmingham is probably about £800 for a room in a house. So we achieve about £1,200 to £1,300 in many of our rooms for one room in a house. So you can kind of work out how much profit they can generate. So essentially the high cash flow, very high return on investment you can achieve. You can force up the values by being strategic, what I was saying earlier on. And at the top level, your competition is very limited. At the entry level, it's very, very competitive in my mind, because it's easier to get into, the barrier to entry is lower. And it's a scalable business where you can just repeat, you create a model and you just repeat and repeat it. This is one of many things we do. I'm not saying this is the holy grail, this is what you should do. I'm giving an example of whatever you do, as long as you do it well, you can get huge results in property. So I think what you're asking is, how do we pick the location? What type of property do we invest in? Right. So if you are parking cash, what I would think about is, if you don't need it in the short term, I'd be looking for where there is potential growth. And how do we identify where there's growth, where there's massive infrastructure changes? So Birmingham prices have gone up massively in the last few years. What's happening in Birmingham city centre? HS2, right? So as that's getting closer and closer, prices have gone up hugely. So when you look for massive infrastructure changes, big shopping centres that are happening, new train stations that are opening, these things are going to drive the price up. They might not happen immediately, but not only are you getting some income, but you are benefiting from pretty much what will be certain capital growth. So I'd be thinking about nice and up-and-coming locations rather than the cheapest. Pitfalls. There's a lot of pitfalls everywhere. Are there pitfalls in any business that you run? Yeah, there are pitfalls everywhere. A lot of it is, how do you protect your revenue and how do you protect your asset? Well, who's actually in your asset and who's your customer, your tenant? So if you are very careful and you vet who you put into the property, that makes a huge difference. The biggest pain that I see many landlords suffering from is tenant problems. And often that's because they weren't managed in the first place in terms of who was put into the property. And we get this stigma that tenants are terrible. Tenants are fantastic. They're your customers. They're paying you each and every month. But you choose who your customer is. Yeah? Excellent. Is that okay?
It's good. Just nice enough. That's really good. Thank you so much.
You're most welcome.
Thank you.